And welcome to another financial analysis video with myself, Moeed Amin, and Ted Wayman. Today, we're going to be looking at B&M Europe. So they're essentially a British Luxembourg variety chain store founded in 1978 with about 32,000 employees. And they have about 3 million customers that walk through their doors per week. So quite a large, substantial business. And they claim to, provide you with, and why they're a variety store, they sell everything from groceries to household goods to even garden furniture and things like that. And they talk about being very price sensitive, or at least they're very good at discounting, offering you the best price. So we're going to look at the financials to see, do their profitability indicate that story. We're going to talk about the share price later on. So that's important. So stick around for that, because that gives you some context in terms of the financial statement and what story that tells us about the business. We're also going to talk about some highlights on the half-year results, which they just published. I think it was about a few weeks ago. So stick around for that as well. We're going to be looking at the financial statement, the annual financial statement. But from our videos, you're going to learn how to read those half-year statements and quarterly statements far more quickly and with a lot more confidence. So quick note on the share price. So if you invested in 2014 when they IPO'd, you'd be sitting on an increase of about 25%. Quite low compared to a lot of the other companies we've looked at there. So maybe the financial statements will give us a bit of a story as to why that might be the case. If you invested 5 years ago, you'd be sitting on a decline of 9%. If you invested a year ago, you'd be sitting on a decline of 41%. So we're going to talk about that in a few moments. So over to you, Ted. Let's share with our viewers what we found out about the company and how they can read financial statements like this for themselves.
Good to see you, Moeed. Welcome back to all of our subscribers. Welcome to anybody who is new to the channel. I hope you find it useful and informative. Here are B&M's annual report and accounts. This is available on their website, very easy to find. Annual report and accounts for 2022, obviously not the whole of 2022, because right now we are recording this, I think it's November 2022. So in these accounts, you will find lots of information about who these guys are, lots more detailed information, who they are, what they do, who the board is, what their responsibilities are, their experience and pedigree, and all the way down to the numbers. And that's really where we're going to start our analysis, is in the numbers. So we are on page 104 of the PDF document that gives us the profitability. Okay, so this is the income statement. We're dealing in millions of pounds. There it is, millions of pounds. So these guys' revenue is 4.6, basically 4.7 million, sorry, 4.7 thousand million. That's 4.7 billion pounds. Okay, a little bit down on the previous year, which was 4.8. So a little drop of 3% from 2021 to 2022. And by 2022, we're talking about March 2022, so kind of the tax year end, for those of you who are familiar with the UK tax year.
Ted, just to confirm, is that 4.6 billion or is it just 4.6 million? Because it just says millions, not thousands of millions.
It's 4.6 billion. So that's 4,000 million, which is 4.6 billion. Okay, so 4.6 billion is the turnover. Okay, so the heading is in pounds millions, and we're giving it as 1,000 million. So 4.6 billion.
Cool.
Apologies if I said 4.6 million. Cost of sales is the cost of the things that they're selling, 3 billion. Okay, and that's about 63%. So when Moeed is sort of saying these guys, they're giving you the best price, basically every, if you buy a piece of garden furniture in their store for, let's say, £100, it costs them £63. Okay, and they're making a profit of 37%, which is actually not that low. So this is pretty cheap stuff that they are buying. So that there is a reasonable margin there, and they need to make that margin, obviously, because they need to run the business. There's the cost of running the business. So admin expenses will be the marketing, the sales team, HR, light, rent, rates, heat, the kind of the cost of renting their stores and heating their stores, etc., etc. So there's going to be a reasonable amount of overhead in there, leaving them with an operating profit of £610 million. Okay, that's about a 13% operating margin, pretty consistent year on year. They've got a little bit of other finance, so it suggests to me that they don't have a huge amount of debt, and they split out the finance between their lease liabilities and their debt, and then they are making a profit. They're paying some tax. Bottom line is they're making a profit of about 420 million pounds. Pretty consistent year on year, and that's a 9% net margin. Now, 9% sounds pretty high to me. I'll give you an example. Tesco, for example, be on about 4 or 5%. So 9% is pretty high, and I think that that is really kind of driven by this gap here. So it looks to me like they've managed to keep their prices relatively high compared to the cost of what they are buying and selling you. So there is the income statement. No real gremlins in there. The debt is easily affordable. Remember, we just we compare the debt to the operating profit. So it doesn't look like they're carrying too much debt or struggling. Let's go and have a look at the balance sheet and see look at their financial strength. So in terms of the balance sheet, these are the non-current assets, the things they need, excuse me, to run the business, and that's really made up of property, plant and equipment, these two numbers here. The split is that you've got the difference between what they own and then right of use assets. So right of use assets will be, for example, if you take, I don't know, the point of sale machines, perhaps they've got those on a hire purchase rather than having bought them. So most of the stuff that these are using to run their business, they don't own, they have leased it. Just to kind of, to show you the other side, we'll see in the liability side, we will see that there are some lease liabilities sitting alongside those. So we kind of read those three numbers in the same breath, so to speak. Current assets, they have got some inventory. So the biggest number is their inventory. We'd expect them to have inventory. We expect it to be pretty high on that inventory. Interestingly enough, their inventory turnover is about 92 days. Okay, so that's quite a challenge for them. So it takes them on average from the day they buy something to the day they sell it, it takes them 92 days. And that kind of makes sense with some of the kind of, they're selling, non-perishable goods. They do have some cash in the bank, 173 million. The trade receivables is basically zero because, of course, if you go into the store, you pay at the checkout before you leave. So because it's a retail store, there's no trade receivables, and that's pretty good for them. That's really their kind of, so the current assets looking is fine. On the liability side, we can just bring up the liabilities. Down here, we've got the current liabilities. We always quickly like to check our current liabilities against our current assets. And we find that, their liquidity is just not a problem there. And even if you eliminate the inventory, and this is a pretty important number, the acid test. So if you eliminate the inventory, actually you get a very different picture. Okay, so you remember the inventory is 863 of that 1.1 billion. So if you eliminate the inventory, then the current assets are 260, which is basically the cash, and they haven't got enough cash to pay those trade payables. So they are very dependent on their ability to sell that inventory. Okay, so these guys really need to make sure that they can sell the inventory. If they can't, then if you are a supplier to these guys, you're going to get a phone call saying, "I'm really sorry, we can't pay you. Can we extend our terms?" Okay, so that's just a little bit of a warning sign out there. That acid test, as it's known. Trade payables at the moment don't look too bad. 42 days. That sounds to me like it's pretty standard. So there's in the current assets, the trade payables is the biggest number there. You've got the lease liabilities we already talked about, and there's a little bit of loans. That's just long-term loans which are falling due now. Most of the loans are sitting here, 950 million, so nearly $1 billion of debt. But it doesn't look like a major problem. It looks to me like they are easily able to afford that debt. So it looks to me they're paying about a 3% rate of interest approximately, and that looks easily affordable. And then we've got those lease liabilities as well. So that's really the balance sheet. So in terms of the equity and the liabilities, 3.6 billion. So here's the equity. Now, the initial look at the equity we see negative equity and we suddenly think, oh, hold on a sec, that's an issue. Actually, it's not an issue because it's merely the way it's being presented. Okay, now this is a little bit of an anomaly here. You don't often see it presented like this. So I'll just run it through. So, what we're looking at here is all of the this is the equity and the liabilities. Liabilities, these amounts here, this is what we owe to third parties. And this amount here, the equity, is what we owe to the shareholders. Okay, it's a voluntary liability. It's not actually a liability because we don't have to pay it. And so when we see this is actually just an amount owed to the shareholders. So the balance sheet is positive. This is a positive 746, but it's just represented because they've been showing all their liabilities with brackets around them. So this is what the shareholders have invested in the business. So that's effectively taken in by the business. And then we've also got the retained earnings, which is here. It's a very relatively small retained earnings of 121, suggesting that they are paying dividends. The difference between these two, they're relatively the same, suggesting that the profit these guys are making is all being paid out as a dividend. So don't get distracted by this, by the fact that this number's got brackets around it. It's a positive balance sheet, if that makes sense. Just looking at so here's the movement in equity. Looking at this column here, the retained earnings column. So we're just going to focus on this section here. We notice that in the previous year they made a profit and they have paid a dividend. There's the dividend compared to the profit. And for this year, again, they've made a profit for the period and they have paid out dividends, both ordinary and special dividends. Okay, so basically all of the profit is being paid out to the shareholders in the form of a dividend. So I hope you, if you are a shareholder, are benefiting from that. Cash flow statement finally. So here we have the cash flow statement. This is the cash generated from operations. Now the reconciliation isn't shown to us. We need to go and have a look at note 23 in order to see the reconciliation between the profit and the cash flow. So we will go and have a quick look at note 23 now. So here is note 23. So the profit before tax is 525. You'll find that in the income statement. There is the cash profit. The cash profit, pretty much the same. We always like to just have a quick look at the big numbers. So depreciation is being added back as a non-cash expense. That's fine. And then what we notice here is a big increase in inventory. So if we go back to the balance sheet, you'll notice that inventories has increased, and that means that cash is tied up. Now, is that a warning sign? Is that saying they're struggling now to sell stuff and they're holding on to it? And if you remember, maybe that's a strategic decision, that they've made a decision they want to hold more inventory, or maybe they're struggling to sell that inventory. And if it's the latter, obviously that is a warning sign, a potential warning sign, because these guys depend on their ability to sell their inventory in order to be able to pay their suppliers. So little bit of a warning sign there, probably what we might call an amber light rather than a red light, so to speak. So back to our cash flow, 600 million in cash. Ignore after the tax, it's 500 million. There's the cash from operating activities. Not a lot of investing going on, a little bit of property, plant and equipment. Again, remember they lease most of it. And then in terms of their financing, quite interesting here that they they're paying out all these dividends. There's the dividends that they're paying, and they are borrowing money. So they are actually issuing debt in order to to fund part of this business. This is the lease repayments going on here, and the interest in relation to the lease repayments. So I think that's quite an interesting. That's an interesting look, that they're borrowing money. They're paying out a lot of money to the shareholders. It looks to me like they're sailing quite close to the wind. I don't think there's any warning signs, but they're straying into my amber signs, if that makes sense. They still got 173 million in the bank, but they are very dependent on their ability to stay open and to carry on selling stuff to pay their suppliers. And obviously headwinds, cost of living crisis, inflation taking off, etc., is going to put downward pressure, especially if they're dealing with people who really have no disposable income. They've got to heat their homes, they've got to pay their mortgages. They're going to cut back on visiting B&M stores. So there are the accounts. I don't think there's anything else really to kind of highlight in there. So let's just go back and look at their share price performance. And here is their share price. So we've seen their share price. They are trading on, their market cap. That's the total value of the business. The market cap is a 3.5 or 3.6 billion pounds. There it is. That's an 8.3 times earnings, just to give you an idea that that's about a 12% yield. Now that's relatively cheap. I think these guys are cheap for a reason. So even down here, they've seen the share price dropping significantly off the market. It looks like they're cheap relative to previous times, but actually I think they are still so they are cheap relative to their previous expenditure, but I think they are cheap for a reason. I think that they are going to encounter headwinds. The dividend yield, I don't think that is really sustainable. The dividend yield is pretty good if you include the share buybacks as well. The sort of the special share, sorry, the special payment as well. You're up to 12% dividend yield. So yeah, I think these guys have some headwinds to contend with, Moeed. Just before I finish, little interesting note. We're just going to look at the in the notes to the the directors information. You will find some information about directors pay, and I just wanted to highlight the directors pay. So on page 84, you can see how much the directors are being paid. Here they are. So Simon Aurora is being paid. So he's seen a lovely pay increase in spite of the share price dropping significantly. His pay has gone from 3 million to over 4 million pounds. Okay, so he is certainly doing very well out of this company, taking 4 million pounds out. And it's quite interesting if we compare that to page 123. So on page 123, you can see the employees and how much they are paid, which I think is an interesting comparison. So here is the employee remuneration. You will notice that the employees are paid 572 million pounds in total. And on average, our little note said there were 32,000. It's now up at about 41,000 employees. So if you pay 41,000 employees 572 million pounds on average, their take-home pay is about 14,000 pounds a year. Okay, so if you're in one of these stores, be nice to the staff. They're not earning very much. Average wage here in the UK is 33,000 pounds. So these guys are earning, they are basically on minimum wage, if not below that. And they are being paid a fraction of the CEO, who is earning almost 300 times the average salary of a worker here. So our CEO is earning 300 times the average pay of the average worker. Are they worth it? Well, I'll leave you to decide that. So there's my analysis, Moeed, for what it's worth. I hope you found that useful, informative, and interesting.
Yeah, very, very useful indeed. Now, quick note, actually, which is really important, and we're going to talk a little bit about their half-annual report, the half-year report, sorry. So this company came in as a request from one of our viewers. In fact, he was so keen on it, he requested it twice. And so, John, here is your video. In fact, 98% of the companies we analyze are requests from our viewers. So if you're interested in a particular company, whether you're selling to them, whether you're thinking about investing in them, or even if you're actually going for an interview with them and you want to sound smart, then do leave a note in the comment section of any of our videos. Our team will capture that and we'll analyze the video for you. Now, John actually made some interesting points here around the share price. It's growing cheap. He feels that, Could the share price go higher? As higher income people might trade down and buy more of their stuff from B&M. And that's interesting. That could be possible, but that is one dimension, and there are various other factors. So if we look at their latest half-year report, which they released in October of 2022, their revenues declined by 0.9%, and their profit declined by 17.9%. Now, what's interesting there is Ted talked about the inventories and how important the inventories are to their liquidity, and the elements of the fact that if they have to hold their inventory for longer, that might cause a stress point in their liquidity and profitability. Turns out that's what happened. So the 17.9% drop in profitability for the half year, they cited were due to factors. And some of these factors were they had surplus outdoor furniture and gardening stock, which they had to sell at a discount. So there's an indication right there. They also cited other reasons for that, such as increase in wages, right? Even though those wages that we talked about were very low, it's still higher on average or at least higher for some of their employees than it was before. So they had to raise and bump those salaries. Stronger competition, higher energy costs, and also the stronger dollar. Now, the reason why the strength in the dollar is an issue is because they get a lot of their stock from Asia, which means that stock they have to buy at a higher price, which means that depresses their profitability. So definitely worth having a look at that, John, because it's not just about maybe wealthier customers starting to buy from them. There are other factors that may affect their finances and therefore their share price. So hopefully that was useful for you. If you liked the video and what we've done here, don't forget to like, share, and subscribe to look at some of our other videos. We also looked at another discount retailer in the UK called Lidl. So check out the video, the analysis that we made on Lidl as well. Very interesting stuff. You start to look at some similar companies with very kind of discount level pricing and therefore the effect on their margins. So until the next video, thank you, Ted. Thank you, everyone else. We'll see you on the next one.
Good to see you, Moe. Catch you later.